Good morning and welcome to Bazaar Morning Call. I am Anuj, with me Prashant and Sonia as always, and we have a screen which in 2 days has turned upside down. It's like that, just 2 or 3 days back the market could do nothing wrong, and now nothing's going right. In fact, if you look at the Indian context, the global cues, just briefly I mentioned all three are negatives. The dollar, the bond yields and crude all have inched up. From our market point of view, we want all of them lower. The dollar index, in fact, very close to 52-week high. The US bond yield above 3% and Brent crude above the 97 mark. So clearly there's a clear risk off which is on right now. Let's see if the Nifty takes support at that 20-day moving average, which comes in at 17,340. If we get there, guys, hi, good morning.
Hi, good morning, Anuj. Morning, Prashant. More like an anti-climax, right? Just when everyone started talking about this being a raging bull market and bulls charge ahead, and that's when, bam, you get that sharp sell-off. But I guess that's how the market works. It never obliges really with what you want to see. In any case, I mean, it was a steep sell-off across the globe. And, Anuj was talking about the Dow. The Nasdaq is well down 2.5%. All 11 S&P 500 sectors ended in the red yesterday. So it was pretty broad-based. There was a decline in IT. There was a decline in consumer stocks. Zoom, by the way, the share slumped quite a bit after they cut their profit, full-year profit forecast. There are, of course, those headwinds. For our own market, too, the Nifty closed below that 17,500 mark yesterday. Both foreign and domestic investors sold in the cash markets, and it was the biggest fall in the last 2 months. So the question now is, has the rally hit a bit of a pause button? And should we expect some more in terms of profit taking, right? I mean, that's the big question. There seems to be no cues as well, major trigger for the market now. So how does one approach it?
Yeah, I think pause it clearly is. Whether it's a halt or not, I think that's something that, you've got to keep an eye on. Look, Sonia, the markets got the fear factor back. I give a lot of importance to what happens to the volatility index in the US, the CBOE VIX. That surged 16% yesterday. I think while the equity markets go up and down, that tells you a bit about that fear factor. Now, if you look at close to close, I don't give too much importance to intraday levels. If you look at close to close, Nifty is right now sitting exactly at 33% retracement of the rally. The rally was big, but just in 2 days, we've given up 33% of that, close to close, almost. That level is 17,465. So the market has to bounce. Today has to be the day, and it has to then sustain above 17,465, because if it does not, then it opens up not only the 20-day moving average probability of 17,340, but also the 50% retracement of this rally, which comes in at 17,220. So all these levels are nearby, within 200, 300 points of each other. So that's something that you've got to keep an eye on. FIs have started to sell again. In fact, in 2 out of last 3 days, FIs have been selling. And the point I made in last week's Editors Roundtable as well, the decline started with Bank Nifty. When the market leading sector leads the decline, you've got to be a bit cautious. In fact, over the last 2 days, you've seen a over 1,000-point decline in the Bank Nifty, which now has the 20-day moving average. If you look at the simple moving average, that's at 37,950. If you're a fan of exponential moving average, that's at 38,050, or I mean, vice versa. But that's the zone which you've got to keep an eye on. The US market, especially the Nasdaq, is showing classical sign of end of a bear market rally. And in that sense, our market has been stronger than the US markets. Obviously, you can't entirely correlate, but if the US market has to make the fresh lows, then I think for our market as well, there would be some problem. But for that to happen, you will need to close below 17,220. But this is funny kind of a market. It just makes you change opinions so fast. Just 3 days back, almost all of us were looking at, the market hitting all-time highs. And look, all of a sudden now everyone's wondering whether it was a bear market rally, and it's ended. So opinions change faster, and, the markets make opinion, right, Prashant?
Oh, absolutely. I mean, prices lead and opinions follow. I remember Warren Buffett's I think it was his first television interview. He was asked, do you think the market was correcting at that point? He was asked, do you think this market correction is an overreaction? And he said, well, it is an overreaction which is correcting a earlier overreaction on the upside. I mean, so I think it just kind of struck me that maybe we're in that kind of a phase. At 15,200 or whatever, it was too stretched on the downside, and then very quickly we came back to 18,000, which was also perhaps a little excessive, also, and we are correcting that.
I love it when the market falls is when people remember Warren Buffett quotes, right? for long-term investing.
Oh yeah, oh yeah.
It's bang on time.
I don't think we're there yet, right? Just what, 500-600 points, not even that actually on the index. Let's just take a quick look at the setup. It's been a disruptive start of the week, absolutely no doubt about it. The two things which we've been highlighting is actually three. The Nifty, which has broken below important trend lines, which you can kind of draw from the all-time highs of 18,604. We are firmly below that. So that is one. The dollar is at 109. The DXY index actually, it's of course firming up against everything else across the board. I mean, the euro has broken parity against the dollar. The Japanese yen is at 137, 138, and you can go on. I mean, the rupee, for example, here. So dollar is firmer. Oil prices is the other one, and we were talking about how oil may be coming alive once again. Yesterday, oil was down 4% when trade started in New York. By close, it was absolutely unchanged, which means it recovered 4.5% from the lows of the day. And that is on the back of statement, which is surprising. It was Saudi Arabia's energy minister who said that because of all of the volatility, they feel that oil prices are unhinged from the realities and the fundamentals of the oil market, which remains tight. So oil should not be here, it should be higher. And they are considering, and they hinted at a potential cut in output on the 5th of September when OPEC Plus meets. So we will see. Oil is an important variable. Yesterday we had Lawrence Blanco who said technically maybe, oil's back, headed back to about 115 odd kind of levels. We will hear from the Fed Chair Jerome Powell on Friday at Jackson Hole. And I think that's going to be, but I think, with markets correcting, the bar for hawkishness is high now. I mean, it's not low. It's not as if, the markets have been rallying and then Fed Chair comes and says something which will disrupt things. I mean, we already disrupted. Whatever little degree, but we're already disrupted. So the bar for that to do any real damage on Friday is a bit higher than it was last week. The 20-day moving average on the Nifty is 17,340. So let's see, we find any supports for that around there, or we head to about 17,100 before we get a bit of a pullback. These levels are the way markets are reacting, not very far away. So I don't think we'll have to wait very long to find out. Sonia.
Okay, absolutely. Also want to point out that there's as we said, there's a Jackson Hole symposium. Nothing really comes out of that which is market moving, but it's good to at least track what's happening over there. And keep an eye out on Brent crude, once again back above $97, almost at $97 a barrel. So we'll be... Yeah.
Sonia, this is interesting, right? The Jackson Hole, we all say that nothing comes out of it, but still every year we keep an eye on it.
Every year we keep an eye, every year we track it minute by minute, and every year we end up saying that, there's no impact.
Also, it's like,
It's like the budget.
It's like the budget. It's like Davos. So many of these things, every we say, lot will come out, but actually nothing comes out.
And every year we start the budget by saying that, the budget is a non-event for the market. And then we cover it for the whole day.
But because, that's...
it's a financial statement.
Yeah, exactly.
So.
At the end of the day, that makes us money, right?
Okay, well, it's different, right? Finance, macros, markets are a different
everything.
beast altogether. Yeah. Okay, well, we'll tell you all the cues that you need to watch out for as we head into trade today. The SGX Nifty for now is indicating a weak start. On the equities front, though, first up, we have Varun Lochab of HDFC Securities, who says that India's long-awaited capex cycle finally seems to be gathering momentum after a hiatus of 10 years. He says while there were false starts in the last decade, they believe that the recent post-COVID pickup is looking sustainable and drivers are in place for a multi-year growth. Their top picks within their coverage universe to play this multi-year theme are financials like ICICI, Axis Bank, Capital Goods, Infra, L&T, Siemens, Cummins, GMR Infra, and capacity expansion-led volume growth in Ultratech, Dalmia Bharat, Navin Fluorine, RT Industries, NTPC, Phoenix Mills, and Havels India.
Okay, on to a quick macro view then. Eric Fishwick of CLSA says that their central case remains that the US dollar remains well supported until growth risks rather than inflation risks drive US rate expectations. He says there is a risk that the US will see labor market strength dissipate surprisingly quickly in the second half, and that the National Bureau of Economic Research retrospectively declared that a recession started in Q2 FY22. But for the moment, he says growth worries are greater still for Europe and China. He advises to stay long US dollar for a while longer and that they will reassess their stance after the Fed raises rates at the September FOMC meeting. Sorry.
And let's get you some money market views as well for the day. Bhaskar Panda of HDFC Bank says all eyes are on the forthcoming Jackson Hole conference where Fed Chair Powell could spell out the future path on rate hikes in the US. Positioning ahead of this has pushed the dollar index higher. Risk-off sentiment prevails, especially in Asia, as China grapples with a slowdown. Crude oil prices rallied a little from recent lows. Given this global background, the dollar-INR pair could again try to test the 80 mark today. He expects the day's range to be 79.75 to 80.
Well, on bonds, Bhaskar Panda says that Indian benchmark bond yields have remained rooted around a narrow pivot, and recent remarks show that the fight with inflation will continue. He does not expect much volatility as the 10-year benchmark yield trades in a range of 7.25 to 7.3%.
Okay, so we have a lot of stock-specific action to track today, and we'll get to that in just a bit in our top 10 segment. So we're looking at Maruti Suzuki, there's Arvind, there's Gokuldas Exports, Welspun India, Sterling and Wilson, Adani Ports also on our radar. All of this on the back of positive news flow. There's also Infosys, Asian Paints, Berger Paints and Devyani International. These are likely to open in the red today.
All right, how are flows set up and what's going on? I mean, are flows really turning negative with the market turning down? Cameron Brandt is Director of Research at EPFR Global, and he's, of course, the best person to put that question to. Cameron, great to have you with us here. Thank you very much. So far, what have we seen? I mean, it's just been a few days, right? I mean, a couple of days in the US and around the world that we're starting to see a bit of a pullback. And the question top of mind is this just a routine pullback or perhaps a bigger fall ahead? Can we answer that question looking at how flows and positioning is?
Yes, the rally we saw, certainly from a fund flows perspective, was not heavily supported. It had some of the characteristics of a summer rally where a relatively modest amount of money can move asset prices more than perhaps more heavily traded periods of the year. And I'm certainly sort of seeing the turn downwards we've seen in the past couple of days as sort of part and parcel of that general pattern.
Okay, Cameron, hi, good morning. We've seen quite a bit of inflows into Indian markets over the last 1 month. Do you have any data to support whether this has been ETF-driven inflows or more of a sort of long-only money?
A little bit more long only. India's been attracting certainly over here, some very favorable investment bank commentary recently, and it certainly hasn't hurt that India's the economy you're most frequently measured against, which is China, has sort of run into definitely a sticky patch. So we've seen a definite uptick in interest in India. With funds based outside of India and with more of a long-term perspective.
Okay, so you're saying that India has been attracting favorable investments from foreign investors. In the emerging market basket, how do you see the trends shape up from here? There's been an inflow of about $20 billion already into emerging markets, but do you expect that inflows could continue, and where does India feature on that list?
So I think they can. We're certainly seeing the start of a reassessment of the sell-off that emerging markets have seen for multiple good reasons. What we tend to see in those early stages is that investors seek either diversified exposure through the global emerging markets funds, or they head towards the big five. India, Korea, China, Brazil. Well, actually, it used to be Russia, but that is obviously not the case now. So I should say at the moment it's the big four. We've definitely been seeing that. Brazil, as well as India equity funds, taking in, I think it was sort of a 4-month high, last week's flows into dedicated India funds. There was a notable spike in flows into both China and Brazil equity funds as well.
Right, you're saying that inflows into India dedicated funds last week, the last set of data that you have, was at a 4-week high.
More than that, I think an 18-week high.
Sorry, okay. All
so
right.
yeah, this has really been a noticeable increase in interest in the biggest emerging markets. And obviously India is a paid-up member of that group.
Right. No, so, you mentioned the big five, right? and you said, well, it used to be 5 at least till Russia was there. But should it, I mean, some are saying that even out of the 4, should it actually just be 3? It's just a hypothetical because of all the problems in China. Are we seeing any of that dramatic sort of movement in flows, etc.? You know, with respect to China, and how will that behave? I mean, what will happen if there are outflows from China? Does it get reallocated to other emerging markets or goes into GEM funds? Yeah.
Right. No, a very good question. What we've been seeing so far is more focus on the collateral damage than China itself. There's still certainly from the institutional flows that we track an assumption that China has both the political will and the fiscal firepower to keep this current pullback at manageable levels. Where we've been seeing China's current issues show up is in flows to funds dedicated to markets like Japan, which relies on China now for a fifth of its exports, and a lot of the smaller Asian markets, which are also, you know, now in a position. It used to be said that when the U.S. sneezed, the rest of the world caught a cold. Certainly now China's relation to its smaller neighbors sort of somewhat fits that particular way of looking at the world.
Cameron, you know, are you starting to see outflows from the commodity-driven markets given the rise in the dollar?
Yeah, in fact, we have not really seen any strong movement this year towards either commodities or energies funds, which, given the inflationary environment and the pricing power that some of the sort of key names in those sectors have found themselves with, is a little bit surprising. But I think that by the time sort of sentiment adjusted to that new reality, investors have also or had already started to look forward to less dynamic economic growth, and also a response to pretty rapid government intervention in some of these sectors. You know, in energy, we've seen efforts to cap prices. Mexico trying to or moving towards renationalizing its energy sector. So I think, somewhat to my surprise, we've not seen strong flows into those fund groups for most of this year, but I now think that the forward picture suggests that that's, not an unreasonable position to take.
Cameron, I didn't quite understand your view, what you said about China. Are you saying you're seeing outflows, or you're saying flows are suggestive that funds will stay put?
What we're seeing at the moment is that people are sticking to their China positions, but they are responding to the events there by cutting exposure to markets that are likely to feel real pain if China's economic issues persist.
Okay. All right, Cameron, we'll leave it at that. Thanks a lot for joining us and giving us a quick check on all that's happening as far as the flows are concerned. Let's slip into a quick commercial break. On the other side, our entire team will be with us. They'll help us with a list of top 10 stocks. Keep it with CNBC-TV18. Back to the show. Well, we're starting with some negative cues this morning, but we have plenty of stocks to talk about. So without wasting any time, let's get our entire team on board. Anuj, what are you looking at today?
Sonia, the IT space, I think, IT platform, all these spaces which had that decline because of the valuation reset and had that counter trend rally. My sense is that that rally is coming to an end. So the weaker part of the stocks, which are now threatening to break the 20-day moving average, HCL Tech and Wipro, those are the two stocks that I'll keep on my radar. I mean, the entire sector itself, but within that, the weak stocks like HCL Tech and Wipro is something that I'll be tracking. But you are tracking Maruti this morning.
So, yesterday there was a very interesting conversation that our managing editor Shireen had with R.C. Bhargav, after 40 years of, completion of the Maruti JV. And the key takeaways, according to me, was that he did mention that there is unlimited scope to expand the car market at the moment. And Maruti is going to do everything that they can in order to be a part of that major expansion. Now, Suzuki will be, of course, focusing on the entry-level market, but the partnership with Toyota will focus on the high-end aspirational market. They also spoke about how the hybrid technology that they've brought on board will bring down the fuel consumption by 35 to 40% for an average consumer, and that will help them in terms of higher demand as well. If all goes to plan, Maruti said that the Haryana plant could become the single largest manufacturing site anywhere in the world after the expansion. A capacity of 1 million cars in one site has not been replicated anywhere else in the world, and things are changing better. So, of course, these are, motherhood larger statements, but they are positive and they indicate that Maruti is well on track to go ahead with the expansion plan. Let's listen in to what R.C. Bhargav had to say.
I think Toyota coming into this has very major significance for us. One, it gives us access to a number of new technologies. For example, this hybrid technology, which is now coming in with the Grand Vitara, is not a technology which is available anywhere else. But we will be introducing this technology, and it brings down fuel consumption by 35–40%. Toyota also has access to the bigger, more branded kind of car technology, so we can get those cars manufactured for the upper segment. So
the Lexus and
up to the Lexus quality if necessary, but in between also the Camrys and the Prius for the hybrids, and those cars are also available. So we will have Suzuki giving us for the Bharat market, and from Toyota we'll get the technologies for the upper market. So that will give us the ability to cater to the full range of the market, and we will be able to find whatever we need to export. Toyota is looking for India to do some kind of production for their export markets also. As everybody knows by now, we have got the next site at Kharkhoda, and if all goes as planned, it'll become one of the largest single manufacturing sites anywhere in the world. 1 million cars are not manufactured in many places at one site. And I don't think Kharkhoda is going to be enough, of course. I think in another 3, 4, 5 years, you'll find we need to go somewhere else also.
Well, very interesting conversation. You can catch excerpts from this interview as part of our special series On the Record with Shireen Bhan all day today only on CNBC-TV18.
Okay, I mean, that's an interesting conversation, Sonia. And, what struck me was the fact that he's saying that Suzuki will focus on entry-level segment, because all of the focus in our conversations with Maruti management has been about SUVs, right? Where they've been lacking. But entry-level has also been struggling, generally for everyone, right? Higher-end cars are doing well, but entry-level where penetration is still very low.
Is struggling, yes.
Car penetration is just under 4% in India, right? But that segment has not been doing as well. So interesting to hear that from Mr. Bhargav. And of course, as Sonia said, we'll play out more of that stuff through the course of the day. Now, Sterling and Wilson should also be in focus today. Nigel is standing by to tell us why. Nigel, hi, morning.
Well, morning. The news that's come earlier today is that, in fact, Sterling and Wilson, they won an order close to around 2,200 crore rupees odd. They have been declared the L1 bidder for a BOS package that comprises of 4 blocks of the proposed solar PV plant of NTPC in Gujarat. So on the back of this news, a rather large order coming in there. Expect the stock to open up well in the green.
Okay, Nigel, thanks a lot for that. Now, Wipro started it, TCS followed it up, and Infosys has slashed variable payout for its employees to protect its margin. That is a money control exclusive. Of course, as I said, TCS and Wipro have already done it, and now it's Infosys' turn. Money Control's Haripriya Suresh has all the details.
In what has become an industry trend, Infosys is now the latest company to make changes to its variable payouts for the first quarter of FY23. Infosys has told employees that they will, on average, the employees will receive 70% of their variable payout, but it depends depending on what their pay grade is and what department they're from. It has attributed this to margin pressures, primarily because of compensation revisions that it has done, as well as talent that it has hired. This, of course, comes soon after both Wipro and TCS have made similar announcements. TCS has deferred the payout for certain grades of employees, whereas Wipro has said that anyone in band C and above will not be receiving the variable payout for this quarter. This, of course, for Infosys, its Q1 operating margins was at 20% and its attrition was at 28.4%. All of them are seeing significant increases in wage costs as well as increased attrition. And what the impact of this move will be on Infosys attrition levels remains to be seen.
Okay, well, I expect all of these stocks to perhaps be under pressure. And you know, this comes at a time, if you remember, a couple of quarters ago, there was talk of these huge salary hikes that most of these IT companies had got. I guess it's just correcting some of those excesses.
I think that clearly that is the case. And you know, there's just too much margin pressure right now on IT companies. So that golden phase, after that, you know, it's always some sort of course correction.
You know, what I'm surprised though is that so quickly back to back, right? I mean, Wipro does it. What, 2 days back? Then there is
which is what we discussed. That you know, Wipro is normally the lead indicator for the sector.
I remember Happiest Minds was on the program, and we asked them they've done it, and they said, well, it may be because you know this variable pay is linked to performance, so it could be company specific, and they kind of dismissed it.
Yeah.
But I mean,
then the whole industry went ahead and did it. Company specific.
They're talking to each other.
I'm sure not. Okay, well, Devyani International is another stock on our radar this morning. There's perhaps a block deal there taking place. Nimesh is here to give us the latest. Nimesh?
Hi, sorry. So the start of a fresh week, and we have another large block deal this time in Devyani International. So the largest public shareholder of Devyani, which is Danan Investments, they are looking to sell up to 3% stake via block deal. The book was launched today morning. The price indicator is between 182 to 196, which means a 7% discount to yesterday's closing price. Now, two important things. One, this particular entity owns 16% stake in Devyani, and there is only a 30-day lockup for this particular investor. So I'll go with red to start with, but there is going to be a supply overhang in Devyani going forward as well.
Okay, all right. We'll keep an eye. Big blocks coming into the market. I mean, actually, you know, all of it getting absorbed. I mean, I think that's the big message that we've seen over the last 1 month or so. Nimesh, thanks very much. Paint companies in focus as well. Mangalam is here with more. Mangalam, hi.
Well, crude prices are back on the boil once again from, you know, lows of almost $91, $92 per barrel. They've risen about $5, though they're still about $40 off the peak. So that should be decent news for the paint industry. But the fact that they are rising from the lows could have an impact on some of these names. In fact, some of them were under pressure in yesterday's trading session itself. We had Asian Paints, Berger Paints lose about 4% Kansai Nerolac was down about 1.5% as well. They are less impacted relatively right now, primarily because a large part of their prices are already contracted. So let's see what happens to these guys from here on. Though, you know, in the second half of this year, these companies believe that they will see some margin improvement, because even though they're rising from the lows, we have seen the paint prices, or rather oil prices, correct a fair amount from the peak.
Fair enough. Thanks a lot for that. Well, Sonal is here to tell us about why she's watching textile companies this morning. Sonal, over to you.
Good morning, Sonia. Well, it's not only crude oil prices which are in focus, even dollar is in focus, because US dollar has strengthened overnight. It is hovering around that 109 mark, and it is because of safe haven flows that we are seeing in this particular currency. On the back of which big exporters, the likes of Gokuldas Exports, you have SP Apparels, Arvind Limited and Welspun India, all of them are in focus because remember, they get a sizable chunk of their revenues coming in from exports itself. Arvind around 51%, Gokuldas Exports completely export oriented, Welspun India more than 90%, and SP Apparels 85%. They could be hedged against some of the currency levels. However, it is a positive that US dollar is strengthening for these companies.
Okay, thanks a lot for that. Here's a quick recap of our top stocks. Stocks with positive news flow. There's Maruti Suzuki, Arvind, Gokuldas Exports, Welspun India, Sterling and Wilson. While stocks with negative news flow, there's Infosys, Asian Paints, Berger Paints, Kansai Nerolac and Devyani International. But let's get a quick handle on what's happening in the world of commodities. Manisha Gupta joins in for that. Manisha, good morning.
Thank you for that, Sonia. Well, I'm looking at the energy prices, which have continued to gain up after the OPEC Secretary General. It now is about Saudi Arabia oil minister also saying that they can cut output for oil if the prices extend decline. I mean, that really seems to be putting some kind of a floor in case of the crude oil prices, which, by the way, have gained up by 5% in this week. And not just crude, the gas prices have been zooming up as well. You have the U.S. gas prices at 14-year highs. The European Union gas prices now trading at a record highs as well. What is not doing so well, clearly, is the rubber prices. The run-up in energy has brought the rubber prices down. 2-year lows because of lower demand from the auto sector as well seems to be weighing onto this place.
Okay, Manisha, thanks for that. Well, let's take a quick break. Up next, we'll connect with Prakash Diwan for some fundamental stock analysis. Stay tuned. Also, we'll get you excerpts of our exclusive conversation with Umang Vora, the Managing Director and Global CEO at Cipla, in our special series On the Record.
Well, the SGX Nifty is down, but actually it's not, that weak. Maybe because the market had digested some of the weakness from the global market. But the big question is, has the market turned, and is this now a market in which, just like we had that big upside, we'll have a big downside? We'll find out. Prakash Diwan is joining us first up on the show. Prakash, hi, good morning. Thanks a lot for joining us. I wanted your thoughts first on the IT stocks, because after Wipro and TCS, now Infosys is also saying that they'll be either delaying or cutting the variable pay. Clearly, this margin pressure is pinching. Stocks corrected, and after that we've seen a decent rally from the lows. But what next?
Good morning, Anuj. So you're absolutely right. I mean, this couldn't have happened if the margin pressure was as benign as probably some of the commentary made it look when the results were out in early July. Interestingly, what's happening is that the moment the leaders start doing it, or the bigger companies start doing it, it becomes almost like a uniform pattern. I mean, if Wipro could do it and live with it, there's no reason why Infosys would not want to do it. So this whole madness that had come into the compensation side on IT companies is probably getting a bit corrected of sorts. Of course, nobody expected it to happen so soon. And the interesting part is that these are companies that are willing to live with the attrition numbers going up. I mean, they already are at a decent, 28%, 26%. It's not that, it's very low. But the whole point is that if you're staring at a recession from the US and the order booking is not going to be as robust, there's no point in chasing talent and building such a big bench. So this is going to be interesting, because now you will probably have utilization rates and efficiency of the workforce getting into so much of play, and offshore onshore differentiation will start making a big difference. So I think it's interesting. It will give us reasons to dissect and segregate how to expect companies to perform. It's not going to be a broad brush performance for all large companies. So there are definitely some differentiators that will come about if this gets to be a slightly deeper trend.
Okay. Well, let's see. For now, there's some fatigue kicking into the IT space for sure. Margins under pressure, variable pay on hold. That's definitely going to impact the stocks. Prakash, good morning. I wanted your thoughts on Cipla, because we'll play out an interview from the management in a while from now. But very interesting takeaways. They're saying that their 10,000 crore India business can double in the next 5 years. And they're looking at big growth in the wellness space as well. Almost 2,500 to 3,000 crore revenues from there. Let's, in fact, if you can just wait a minute, let's in fact listen into what the management had to say. And then we'll come back to Prakash for his views.
Well, we think India can possibly double from where it is today. We have about a 10,000 crore business in India. We believe that business has the potential to double in 5 years. And I think obviously it'll be augmented with an organic play, but also organic consumption, if I was to say that. But, let's look at the demographic factors for India. We have so a couple of things have been enabled in the Indian context. The first is just the birth of insurance through Ayushman Bharat and several other schemes. And this creates affordability for a lot of procedures that used to sit outside of several families. So I think from a government side, this has been a very big boost. The second is just the deepening of hospitals. If you were to travel in the interiors of India about 5 or 7 years back, and you were to do the same trip today, you'd suddenly see a lot of hospitals, lots of clinics, lots of chemist stores coming up in these cities. And I think that's, people don't need to travel necessarily to metros or tier 1 towns now to get treatment. They can hope to get it in the tier 2 towns and the tier 3 towns. So we see these as huge enablers of growth in this part of the country. So I think it's going to, for us, India is likely to be a market that doubles hopefully in 5 years, aided inorganically as well. And that's the opportunity for us. So we're 45% of the sale. We're hoping to keep the same percentage constant going forward as India begins to leap as much as some of the other markets that we are focused on.
Right. Umang, let me then talk to you about what's happening as far as the U.S. market is concerned. And there are a fair number of headwinds that companies in the pharmaceutical space are dealing with when it comes to the U.S. market. But let's start by talking about the opportunities and what the pipeline looks like in terms of launches and what that could potentially mean in terms of the size of your U.S. business. Currently about, what, 150 plus million? Where do you anticipate that going in light of the launches that you expect over the next few years?
Our U.S. business is about 500 million, and we are hoping that that business also could benefit significantly out of launches that are coming. We think that the launches of products that we've been public about in the asthma and the COPD space are significant opportunities for us and for our size in the U.S. We also look at the peptide trajectory of products that we've been able to partner, develop on our own, which is also very significant. Each of these products could be very, very meaningful, almost to the extent of 10-15% and upwards of our current base. So as we see a range of products which are there, I think this business could significantly increase from the current levels to the levels that we think in 5 years. We think even this business has the potential of doubling in size in the next 5 years or so.
But how challenging is the pricing environment? You know, your peers that I was speaking to said that, look, pricing pressure is the reality that you have to live with. You cannot ignore it. And it's only expected to perhaps worsen given the administration's sort of very determined focus on ensuring that prices come down, which may not necessarily impact Indian pharma as much. But what's the pricing environment looking like at this point in time, and how much of a risk is that potentially going to be?
So the pricing environment in the US historically, if you were to go rewind back about 15 years, has always been the 0 to 5, 0 to 10% type of price erosion that happens every year. The market deflates. And I think what happens is the only way to offset that is through new product launches. I think it works for us a little differently than the others, Shireen, and the reason for that is that our business is a relatively lesser size. So if the business becomes a larger size, your innovation engine has to work that much harder to be able to get the same benefit in your top line to avoid what you're deflating through pricing. So I think we don't have the same problem over the next 3 to 4 years. We, of course, have to erode pricing every year because of the nature of the market, but we don't have that significant a challenge over the next 3 to 4 years. But if you're asking me 4 years and beyond, would our challenges be roughly the same as what the rest of the industry faces? Probably yes. And that's when the innovation engine will continue to have to fire at a different level, a different speed. And maybe there would be more types of products like biosimilars that would enter our portfolio at that point in time.
As a really confident Umang Bora of Cipla saying that price erosion is not an issue and they're expecting to double their India business. You can catch excerpts as part of our special series On the Record with Shireen Bhan all day today only on CNBC-TV18. But let's get back to Prakash Diwan. This was the question that I posed to him. Is Cipla a stock to buy right now? Prakash, over to you.
Oh, absolutely. I mean, I think this is one stock, Sonia, that doesn't give you sleepless nights, irrespective of whatever happens in the US and globally. They've been able to withstand most of this. And very clearly what Umang was mentioning about, I mean, if the price erosion is already is anticipated by the management, it's no more a risk, right? I mean, you work towards it in that sense. And interestingly, the India business, which is the more profitable part, rather than being into the US generics or, some capital allocation to specialties, which has a long drawn return profile, they've managed to do very specific launches which have done well. And, this is one stock from a price perspective, which is what investors would want to look at. If you look at, it's probably the only pharma stock that's not very off the 52-week high, right? I mean, it's kind of withstood this pressure even in the month of May and June, and now it's just probably about 5% short of its 52-week mark, and it never is volatile. So I think it's a great portfolio pick. Don't expect fireworks because there's nothing that suddenly is going to help it double or something, but it stands on a very strong footing in terms of its portfolio mix and the geographical focus that it has on the right pockets, Sonia.
Okay. Prakash, just to come back to that IT point, I mean, of course, one is direct implications for IT, but, IT professionals and what they get paid, variable, not variable, is a big driver of a lot of consumption, right? A lot of consumption sectors,
Yes.
real estate, etc. as well.
Yeah.
Discretionary consumption, big time, across large cities. Is that, one doesn't know if this is a start of something deeper, but any way to think about this?
No, that's an interesting point, Prashant, because we've always seen, wage hikes from a more secular standpoint have resulted in such great translation into the Bangalore housing market picking up, Pune picking up. So we've seen anecdotally this does happen. But the situation that we are right now in is more about how IT professionals get paid, how it is sliced in terms of their fixed and variable this. I mean, you heard the management of Wipro talking against moonlighting for some reasons that they've figured out is not efficient for the organization as a whole. So so what's going to happen is the nature of revenue generation or income generation for these professionals could change. And people will probably be more project specific, more assignment specific, rather than being on the wage roles and just kind of keep on expecting. So that might alter a little bit of that portfolio, of that consumption dispensation. But I don't think it's such a significant play as yet. Unless, as I said, if this trend gets into vogue and you have this cut across this thing, and even the number of the headcount starts shrinking, that's the biggest worry. This might not result into so much of this. Whether disposable income is what we are talking about, seeing a little bit of a thing for a slice of professionals. But yes, it does have a bearing, and hopefully we will outlive that in terms of the growth from other pockets.
Okay, Prakash, stock that we normally don't discuss often, Suzlon. What's happening here? Anything that you've heard? It's been the top traded counter for some time now. I mean, just right after Zomato, and quite a bit of excitement in the stock, even in a weak market.
Oh, yes. Interesting that you picked this, Anuj. I know these things you don't miss out on. The market's been a bit abuzz with, revival of things, things that seem finally more constructive than just hope. And to be honest, the kind of pickup that you've seen in the wind energy sector, it's gone through a severe consolidation, a brutal consolidation. Whoever is left out is actually now reaping in the benefits. And there is a possibility that the government might start focusing on wind as much more than what they've done on solar. And we've seen the results in solar. So renewables, and traditionally, wind power is something that we've had just a few pockets there where we've seen some affluence happen with Tamil Nadu, Gujarat and all. But there is a huge potential on offshore wind projects coming up. And if that picks up, and just to give you some data, the wind energy contribution in the US renewables portfolio is the largest. And then you have things like solar and gas and biomass and all. So we are kind of behind on that curve. And if that were to happen, the government focusing on this, you could have some revival in this business as well. And they've got all the excess baggage out, which is good for the balance sheet also. But it still needs repair. I mean, I'm not too sure whether at $8-9 it's a great story as yet. Let the narrative actually play out and move from a hope to a promise kind of a thing. And then probably things would look better. But yes, I can see the screen is smartening up for this counter for the last couple of weeks.
Okay, well, I guess you got to be a really nimble trader, right? In stocks like this, you could burn your fingers, and people have lost a lot of money in names like this. So better to put that caveat on board. I do want your thoughts, though, on Metro Brands, because it's the first corporate on our that we're speaking to today. And the stock has had a very strong run-up. The current price is around, 800 rupees. The issue price was 500 rupees. And as we know, the company is backed by Rakesh Jhunjhunwala pre-IPO. His company, of course, owns 14% stake in Metro Brands, and it has reported its best ever revenues, EBITDA and profitability. So it's looking pretty good at the moment. Nissan Joseph, who's the Chief Executive Officer at Metro Brands, joins us now to talk about that. Mr. Joseph, good morning and thanks a lot for joining us. I just want to ask you about the growth plans that you have. What was the same-store sales growth in Q1 and how has it been in Q2 up until now? What is the sustainable growth rate that you're looking at?
Right. So I think, Sonia, thanks for having me here this morning. We don't disclose same-store sales growth, but I can assure you that all of our concepts of Metro, Mochi, Walkway and Crocs had some very nice gains in all the markets that they operate in all the different categories that we sell in. As we look to the following quarter, the RAI reported strong numbers for July, and Metro is definitely part of that momentum that seems to be happening in India all over. Inflation doesn't seem to have affected the demand as much as one would have thought it might have. We continue to see good demand for our products across tiers, across categories. So, I think it speaks well to the strength of the overall economy of India. As consumers' incomes are rising and their aspirations are rising, they're looking to upgrade their lives, and Metro plays very well into that space of, affordable premium products.
Mr. Joseph, hi, good morning. If you were to divide your products price-wise in different buckets, starting from the lowest end to the highest end, is there any pressure at all at the lower end? I mean, is there a difference in growth rates also? Yes.
Sure. So we've seen a drop off in actually the low end of the spectrum, but that's really caused by the increase of price, caused by the GST increase that went from 5% to 12%. But overall, we've seen our average selling price increase considerably. We've seen that our growth has actually come from the above 3,000 sector as well. So we're not seeing that erosion happening in the lower end of the sector as one would have thought would happen. But at the same time, where we're seeing some deflation in sales is only because we've exited those categories as we've taken price increases, or there's been GST increases in those segments of the shoes.
No, I mean, the only point is that, if so, then the pressure is on the higher end segments to do better, and and that segment has been doing well, not just for you, but for others as well. But if the lower end is not picking up in terms of volumes, etc., and you're saying that you're exited some of that as well, is there disproportionate pressure on the premium end to do very well? I mean, to continue to do well, to kind of drive this engine?
Sure. I think the thing to remember is when you sell a premium product, it offsets a lot of the low-end product sales that you may or may not have had. So that's number one. And then, when you talk about a 5% or a 10% hike in a product that's 500 rupees versus 3,000 rupees, the delta of volume is enough to offset any kind of loss of units that you may have on the lower end of the segment. But we're very pleased to see that most of our tiers of price are growing. The only one, like I mentioned before, that we've seen a decline is at the lowest end, but that's really been caused by us raising our prices due to the GST increases.
Okay. Can you tell us about what the expectation is going forward in terms of your expansion plans? You did say that you intend to open 5 FitFlop stores in FY23. Are you on track to do that? And what kind of realizations are you looking at in terms of FitFlop? What could it do to your blended margins?
Yeah, so the amazing thing with India right now is there's a huge rush of retailers opening stores all across India, and we're seeing that rentals are getting quite expensive again, and that's okay because I think it speaks to the economy at large in general, and that bodes well for all retailers in India. Having said that, we're very comfortable with the 2 guidances that we've given, which is we'll open 260 stores in the 3 years after we listed, and the fact that we're going to add on an additional 5 stores this year of FitFlop. From a margin perspective, Sonia, what we see is that all of these brands that we bring into the country under our own direction, under our own wings, tend to be margin accretive to us. They do not tend to be margin dilutive, both at the top end and, of course, at the flow-through rate as well. While I think FitFlop is also a premium product, right? So let's not forget that the average FitFlop sells for 7,000 rupees for a sandal. Obviously the demand for that product is not as robust as something that might have been priced at 2,000 rupees. Having said that, though, there is a lot of demand for the product that we've seen across India that we feel optimistic and comfortable with our guidance of 5 stores.
You said 7,000, Mr. Joseph? A flip-flop?
FitFlop, yes.
Yeah, the FitFlop brand is actually, it's quite premium. I mean, as opposed to contrary to what people think, right? I mean, it is an expensive product, no 2 ways about that. But all right, Mr. Joseph, if you can just tell us how is the e-commerce platform doing for you in the sense you have about, I think, 7 to 8% of your business that comes from e-commerce currently. Given this rising trend of people shopping online, you think it's going to go up in the near future? And how does that change the business economics for you?
Yeah, so I think it's been very exciting for us to see Q1, Sonia, from the standpoint that we saw e-commerce continue its double-digit growth for us. At the same time, we saw some huge increases in the offline space. I think that what that shows is, the consumer, while they looked at e-commerce as a channel while we had COVID, are now seeing it as an optional channel as opposed to the go-to channel. They still love offline shopping, as is being shown by the performance of our stores, our brick and mortar stores. But I don't see e-commerce necessarily going away, which is exciting. But the beautiful part about e-commerce is it's moved from being a discount-led channel to really a convenience-led channel where consumers are willing to pay the full price for the products that they get, as opposed to the big discount hunt that it used to be. So we continue to see that trend of consumers wanting to buy the right products at the right price on e-commerce as they do in our stores. So that is very exciting for us to see that growth continue, even though stores have come back very strong post the COVID restrictions being lifted.
How many pairs of footwear did you sell, Mr. Joseph, say in FY22, and how many will you sell this year? I mean, what kind of growth are we expecting in volumes in 23 and 24?
So I think it's a little hard for me to give future-looking statements, and I think you'll respect that. But having said that, though, I think, the robustness of India continues. I think we've only scratched the surface of the opportunity in India, both as metro brands, but also as a nation. We have a bright future ahead of us for the next 10 years. When you look at all the emerging markets, India has a wonderful story with regards to, the under-indexed manufacturing that we have, the under-indexed services that we have. So that bodes well for metro brands as we look to the future. The other key thing to understand is that middle-class incomes are rising, and so do aspirations when middle-class incomes rise. And the conversion of Tier 3 cities to Tier 2 or Tier 4 cities to Tier 3 cities, that continues to make opportunities for our stores, whether it's Metro, Mochi, or Walkway, or Crocs, or FitFlop, to open in more towns across India.
Okay, well, it's been a stellar ride that your stock has seen. It's up 50% in the last 6 months. All the best, and hope you reach fruition as far as your expansion plans are concerned. Let's slip into a quick break. That's Metro Brands, one of the strongest stocks, and now riding on the consumption story. We'll come back from the break and talk to Mitesh Thakkar and Sudarshan Sukhani for some technical trades. Stay tuned.
Welcome back. Well, let's take some technical calls. We've had two back-to-back brutal days on the downside for the market. The Nifty was down over 200 points on Friday, nearly, and yesterday as well was down over 200 points. This morning, the SGX is indicating that we'll follow up with another 75-80 point decline. Sudarshan and Mitesh joining us. Good morning, Sudarshan. Has the trend changed firmly? Is this now a sell-on rally market? How would you approach it?
Good morning, Anuj. Well, you described it very well, brutal. That happens in most markets and in our market often, so we don't have to worry about it. My point is that this market we are in a bull market. Now, this 200-point decline could have happened in 3 days and that would have made us comfortable. But for so many reasons, it happened in just 1 day and back-to-back days of 400 points. The trend has not changed. And for me, going long is much easier than going short. Short side trades always invariably become choppy, except for the 2 days we see. So on a longer term basis, I have to wait patiently for markets to stabilize, show signs of base building, and then look to go long. Has the texture of the market changed? It's too early to say that. As of now, the trade is don't do anything, look for stability, and then see what the market does.
Okay.
But here there's something else. I'm sorry.
Sure, go ahead. Go ahead.
If at all you want to go short, and then maybe people who want to go short in the Nifty. The bank Nifty is outperforming. Do not go short there.
So you already gave me your view on Bank Nifty. Mitesh, good morning. How would you approach both Nifty and Bank Nifty incrementally? And just in the near term, the kind of decline that we've seen yesterday, the market ending at the lowest point of the day.
Yeah. Good morning, Anuj. We've been calling for this decline for the last few days, and I think, yesterday we talked about targets of 17,500, 550 and possibly 17,420. Now, today, I think we'll open around that 17,420 level, which for me is an important support area. I think the key observation to be made post the opening would be whether we see a follow-through decline or not. If not, then we'll possibly try to explore long on the indices with a 20-point stop below the early half an hour morning low, and then take it from there. But otherwise, this is a market which is broadly positive, but was extremely overbought, was too far away from its moving averages. I think this overall movement is just correcting that. You will see if the 17,400, 420 level holds, then you will see a consolidation of about 400-500 points, and then we'll resume the uptrend again. But today, I think in that sense would be a very important level to check. Similarly, on the Bank Nifty, I think today I would want to see the Bank Nifty take support around this 38,000, 37,950 level. If that holds, then I think the first leg of downward could possibly be over today, and then we might see a decent bounce back. But overall, I don't think it will be start of an uptrend. But yes, I think it will lead to some kind of consolidation with bases around 17,400 for the Nifty and 38,000 or thereabouts for the Bank Nifty.
All right. We'll do one thing. We'll take a break and we'll come back and take the stock picks. After this break, the pre-opening rates will also be with us, and we'll also be joined by Rahul Gautam, Managing Director at Sheela Foam.